Section 6. Unit 2, Secondary Mortgage Market Concepts. Introduction and Objectives. Lesson 1, Government-Sponsored Enterprises. Lesson 2, Federal Housing Finance Agency. Lesson 3, Conforming versus Non-Conforming Loans. Lesson 4, Qualified Mortgages. Government-Sponsored Enterprises. Government-sponsored enterprises, GSEs, are private companies such as Fannie Mae, Freddie Mac, and the Federal Home Loan Bank, created by the U.S. Congress to make borrowing easier and more cost-effective. Commonly, GSEs serve homeowners, farmers, and students. GSEs are not government entities but are backed by the U.S. government. How would you like to be a GSE? Just look at the perks GSEs receive. They have a line of credit with the U.S. Treasury. They don't have to register their securities with the Securities and Exchange Commission, as MBS issuers do. They're not required to pay local or state corporate income taxes, as other private corporations do. GSEs are regulated by the Federal Housing Finance Agency, FHFA, and play an integral role in providing capital to lenders in the housing market by making borrowing easier and more cost-effective. What is a qualified mortgage? A qualified mortgage is a loan with less risky features and protections that make it more likely that you'll be able to afford your loan. Types of qualified loans include all government-backed loans guaranteed or insured by the Department of Housing and Urban Development, HUD/Federal Housing Administration, FHA, the U.S. Department of Agriculture, USDA, and the Department of Veterans Affairs, VA. All other mortgages, including conventional loans backed by Fannie Mae and Freddie Mac, and jumbo loans must meet special requirements to be considered qualified loans. A lender must make a good faith effort to determine that you have the ability to repay your mortgage before giving it to you. This is known as the ability to repay rule. If your loan is a qualified mortgage, it means the loan met certain requirements and it's assumed that the lender followed the ability to repay rule. Generally, the requirements for a qualified mortgage include no risky loan features, such as an interest-only period, when you pay only the interest without paying down the principal, which is the amount of money you borrowed. Negative amortization, which can allow your loan principal to increase over time, even though you're making payments. Balloon payments, which are larger than usual payments at the end of a loan term. The loan term is the length of time over which your loan should be paid back. Note that balloon payments are allowed under certain conditions for loans made by small lenders. Loan terms that are longer than 30 years. A limit on the price of your loan. The annual percentage rate, or APR, on most qualified mortgages cannot be higher than a particular threshold. This threshold can depend on the type or size of your loan. This limit does not apply to seasoned and small creditor qualified mortgages. A limit on upfront points and fees. If you get a qualified mortgage, there are limits on the amount of certain upfront points and fees your lender can charge. These limits will depend on the size of your loan. Not all charges, like the cost of FHA insurance premiums, for example, are included in this limit. If the points and fees exceed the threshold, then the loan can't be considered a qualified mortgage. A requirement to consider and verify income or assets and debts. For your loan to be a qualified mortgage, your lender must consider and verify your current monthly income or assets, other than the value of the property that will secure your loan, and your monthly debt. Your lender must also consider either how much of your income can go towards your monthly debt, including your mortgage and all other monthly debt payments, known as your debt-to-income ratio, or how much of your income you will have left over after paying your monthly debt, known as your residual income. Loan limits. The Federal Housing Finance Agency, FHFA, publishes annual conforming loan limit values that apply to all conventional loans delivered to Fannie Mae. These include baseline and high-cost area loan limits. High-cost areas vary by geographic location. Loan limit values for 2025. The conforming loan limits for 2025 have increased and apply to loans delivered to Fannie Mae in 2025, even if originated prior to January 1, 2025. Refer to Lender Letter LL 2024-03 for specific requirements. Federal Housing Finance Agency. The Federal Housing Finance Agency, FHFA, was created in 2008 in response to the 2007 financial crisis. Its creation was the result of a statutory merger of the Federal Housing Finance Board, FHFB, the Office of Federal Housing Enterprise Oversight, and the government-sponsored Enterprise Mission Team from the U.S. Department of Housing and Urban Development. It established conservatorship over Fannie Mae and Freddie Mac, taking over both management and power from their boards of directors, and also regulates the 12 federal home loan banks. To keep them afloat after their severe losses from mortgage-backed securities, MBSs, and other debt obligation instruments, the U.S. Treasury bought stock in both Fannie Mae and Freddie Mac. Next, the FHFA sued other financial institutions to recover some of those losses, claiming that the institutions had improperly represented the quality of the MBSs sold. In addition to its oversight and cleanup responsibilities, FHFA sets limits for conforming loans, percentage targets for loans made to low and moderate income borrowers,